Hello, hello. Good morning, good afternoon, good evening, wherever you are in the world. I see that Ray is with us. So Ray, I guess you're in the UK, so it's afternoon for you. Good afternoon. Welcome to the Nailing FX session for today. Today, obviously, we're going to cover some swing trading opportunities. That's the point of the sessions that I do. Of course, you can apply these same methodologies or same technologies to other styles as well. So if you prefer to be a day trader, or if you prefer to invest or position trade longer term, then you would literally just change the time frames of the things that we're doing. So hopefully it makes sense as we go through. Even if you don't swing trade, hopefully it'll be helpful. So for the benefit of the recording, I know Ray, you've been with us a few times, but for the benefit of the recording for people that might watch this post the session, you'll just see there on the side, if you tilt your head a little bit, we have my email address there, which is becky@tradewithufos.com. So you can email me as we go through the session or after the session. If something confuses you or if you have questions, by all means reach out. Actually, the better way of getting hold of me, or the way I would prefer it, would be through tradewithufos.com/Becky. Now, the reason that is the better way to do things is because, if I just bring this up here, if you come to this link and you come down here to about the middle of the page, you'll see that there's a question and answer section. So once you've signed up for a free membership, and you literally just fill in your name and email address and just follow the steps, once you've done that, you can then ask a question in a public area. Now, why is that a good thing? It's a good thing because other people can see the answers. So if some people have questions, sometimes they can come here and figure out that the answer to the question is already here because somebody else has already asked it. Or if you have a question that nobody else has asked yet, it might be that other people might come and see that and then again find it useful to see the answer to your question. So much better to do it in a public area, I think, because it's better for everybody. Or you can email me, whatever feels most comfortable. Okay, so just to come back here, just need to make sure that we cover the disclaimers. So let's get that done. So I won't read them to you, but it is important that you guys have a little look at those disclaimers, not just for legal reasons, but of course it's important that you have the right expectation set and that you understand that when we go through these kind of sessions, when we put trades on, when we're using the technology, it is more a demonstration of how we use the technology. It's not a you should trade this or you shouldn't trade that. That's ultimately up to you. Your trade plan is the most important thing. If you use this technology, then hopefully it will help to guide you in how you use it. If you don't, then hopefully it'll give you an idea of how it could be used, and then you can go from there if you think it makes sense. Okay, so the first thing that I want to do, I'm going to come to the economic calendar. Now, why do I do that? To be fair, we all use this in different ways. So for me, what I've done is I've filtered by this week, so I can see a sort of weekly view, and again, you can look at next week as well. And I've filtered by high impact news. And I've chosen all for the country. That's because we're going to be trading currencies. Obviously, with currencies, you're trading different sort of representations of countries across each other kind of thing. So why do we do this? Now, we can use this for different reasons. So some people may use this to say, okay, if there's high impact news coming out, let's come down to today, so Wednesday. If there's high impact news coming out today, Euro's already done on, say, the Aussie and the US dollar, maybe I want to avoid that cross pair, or maybe I want to avoid each of those individual currencies. Now, some people might say that's no problem. I have no problem trading something where high impact news might affect the markets, because if volatility goes in my favor, that's a good thing. But you might use it to say maybe reduce your risk a little bit. So again, we interpret this in different ways. For me, I'm mainly focused on this here tomorrow. There's a lot of news going on with the pound. So I would potentially avoid the pound myself tomorrow. I see this more as being more conservative. I tend to avoid things if there's going to be lots of volatility. I'd rather keep away from that. That's not to say that's the right way to think about it. That's ultimately up to you guys. But I do think it's helpful to know what's coming up and to know where you might have volatility. So that's the first thing that we start with. So like I said, I might avoid pound pairs today because if we're swing trading, our trades might last a few days to a few weeks. So I don't want to be caught in any volatility with the pound. So I might avoid that. But otherwise, there's nothing much coming out for many different high impact news for other currencies. So we'll just avoid the pound for today. So I'm just going to cover the trade that we put on last time. So this was the trade that we put on last time on the New Zealand Japanese yen. So I'm just going to unsquish this a little bit. So this black line at the top, and you'll have to forgive me. Oh no, I've got it, there you go. And this black line at the top was our entry. Black line at the bottom was our stop. This green line here was our first target, our safety target. And then if I squish this down a bit, this green line up here was our final target. Now, depending on when you put this trade on, if you got into it in time, this was either a brilliant trade, where if I squish this all up and we can see, a brilliant trade that went forward, hit our safety target, hit our final target within a day, which would be very happy with that when we're swing trading. But it could have been that we missed the trade. So it depends on the time of day that you put this trade on. So if I just hover over the last trigger that we possibly could have had, which was this candle here, you'll see there that that was the candle that started 1448. That's a 21-minute chart. So it closed that candle. The next, the time that it would have finished would have been 1509. So depending on when we put that trade on, I can't remember exactly the timing in that last session. We obviously start at 2:30 p.m. This is GMT, so British time. We might have put it on before that triggered. We might have put it on just after it triggered. So we can go back and check that recording and see whether or not we got there on time. If we did, crack and trade. If we didn't, a bit disappointing when we miss these kind of things, but you know, loads more opportunities out there all the time, so no problem. Okay, so we're going to look for new opportunities now today. And what we're going to do first with this is come to our TradeStation scanner. Now, why do we use this? Now, first thing we need to understand before we look at the scanners is what we should be doing when we're looking at trading opportunities. What's the first thing we should be looking at? Well, when we're trading, really the first thing we want to know is, should I be long, short, or do nothing? That's the first thing we need to know. Now, there are lots of trading methodologies out there that are mainly focused on whether or not you're long or short, buy or sell. Actually, what's really, really important is doing nothing sometimes. And that's because when we're trading, we're risking time and we're risking money. That why would we risk both of those things if we don't have probabilities on our side? What's the chances that there's good probabilities either long or short? You know, there might be more chances that it's not good either way. And so we want to know where the probabilities lie and where our money and where our time is best spent. So sometimes do nothing is the answer. Otherwise, if we're going to decide that we're going to trade, we want to know, am I going to be long or am I going to be short? Now we use our Auto Climate app to do that. So what I'm just going to do is show you the Auto Climate app on here on TradingView. You guys let me know as well. By the way, obviously some of you might use TradingView all the time. Some of you might use TradeStation all the time. You might use other platforms. So let me know. Hopefully it will make sense as I show you on the different platforms what we use them for. But let me know. So here on this left-hand side is where we have our Auto Climate. Now the Auto Climate app is basically a piece of technology that's scanning through loads of different sort of market data, and it's coming back to say to us, either in the form of a thick blue candle, a thick red candle, or a thin candle of either color, it's coming back and telling us in the form of one of those things where the probabilities lie. So if it's a thick blue candle like we have right now on this example, that tells us it's a confirmed upwards trend, confirmed upwards climate, probability to the upside, and therefore it would be a good idea to look to go long. Now, it doesn't mean we're just going to press buy at whatever the price is now. There's still further steps to this, but at least the first question is answered. Where, you know, should we be long or short? And the question that is answered here, it would be long. Now, if it was a thick red dot, say something like this, that would tell us probabilities to the downside, confirmed downwards climate, probabilities downwards, and therefore we should look to be short. If it's a thin dot of either color, so you see here there's a couple of thin dots, that tells us probabilities neither direction, which means do nothing. So Auto Climate answers that question for us, long, short, or do nothing. So coming back to the scanner, the reason we use these scanners is because rather than filter through and go through all of your watch lists, you know, maybe you have 20, 50, I don't know, loads of different currency pairs that you could be looking at on different time frames. How do you know where the probabilities are to, again, save your time? The scanners are helpful. They're not essential. If you don't have TradeStation and you can't have these scanners, it's not the end of the world. You just look through the different things on your watch list and see where the opportunities lie. But using the scanners, for me at least, just helps to narrow down that time, because essentially what this is doing is scanning through all of that Auto Climate data and coming back to show us where we have near opportunities and where we have confirmed opportunities. So everybody with me so far in terms of what we use the scanners for? Let me know if it don't make sense or anything, and I'll explain it more. Sorry, I should have said let me know if it doesn't make sense. That's better English. Okay, so I'll continue explaining, but again, I'll just keep my eye on the chat box if you guys need me to cover anything again. So what we want to look for in these scans is, first of all, you'll see that we've got these little yellow boxes. So these little yellow boxes, you'll see they all say near. They say the word near. And why is that important? Again, what those are showing us is, yes, you might have a confirmed upwards climate on a particular market, but if it's far away from an ideal trading price, and we'll get onto that in a minute, then it's kind of a waste of my time to go and analyze it, because all I'm going to do is realize that actually there's no point placing that trade. I'm going to have to wait a little while before the things line up in the way that they need to. So what we need to know on this near element of our scans here is where we have opportunities that are close to us, which means opportunities that are best use of our time, because we're going to place them and most probably get triggered into them soon. But that's not all we want to know. So you'll also see with these yellow boxes, we have near sensible, long or short, or we have near hopeful. So you might see in these things here, near hopeful. Now again, as traders, we don't want to be hopeful. That doesn't scream statistics and probability. That doesn't scream being objective. Being hopeful is not a good idea. So we want a near sensible, long or short. Doesn't matter either way. We don't care whether we buy or sell, as long as we're going in the right direction with the probabilities on our side. So we want to look for near sensible, long or short. And now there's one extra element to this on the scanners to again help use our time more efficiently. So you might see if we just take this section here, there's two at the top here, because you'll see under 60-minute climates for the Aussie dollar and the dollar Canadian, we have near sensible longs, both near sensible longs. But there's a difference between each of these. The difference is this column here. Oh, I did that weird. This column here at the start. The top box is grey, the bottom box is blue. Now why is that important? The top box being grey is telling us lack of probability. The bottom box being blue is telling us probabilities to the upside. So we know we have probabilities to the upside, that we know when we go and look at that market on a 60-minute time frame, that's what the auto climate is going to tell us. We also know that we have a good opportunity to go long with prices being close to an ideal trading price. Now, that's still not to say that there's definitely a trading opportunity here. There's other things we have to factor in. But at least with this scanner information, it saved us time going through each of these individually to figure out that we might have had a good opportunity on the dollar Canadian. So hopefully that all makes sense, guys. Let me know. I can come back and explain them. Otherwise, I'll go and take a look at the Aussie Canadian, the US dollar Canadian. Okay, so by the way, the data that I'm using, I'm just clicking the top one coming from FXCM. The great thing with TradingView is you can connect this to different brokers. So if you use FXCM, great, you can see the data coming through from it. I'll go travel over my chart. If you use Oanda or if you use another Forex broker, a lot of them are connected to TradingView. So you can look at the data that's specifically coming from the broker that you use, which is really helpful. And then if you're connected to that broker, you can place trades from TradingView that then route to your broker, which again is more efficient use of time. I quite like that element. So like we said, we're on the wrong time from there. Just go to 60 minutes on that side, which would then be 8 minutes on that side. Okay. So this is a shorter term swing trade. It could be a day trade. It depends on how quickly these things happen. So let me just get to the end on here. There we go. Okay, so we saw when we had our scanners that we would expect a thick blue dot, a confirmed upwards climate. That's what we have. We also have a sensible long, meaning it's a better idea, more probabilities to go long. We have down here, if we just look at this, sustainability stats. I'm not going to go into exactly what these mean today because that will take a little while, but just as a general, in a nutshell overview, what these statistics tell us is that usually this market would go up for 5.4 candles. Let's round that up to 6 candles because you can't have obviously percentages or decimal points of a candle. It's either there or it's not. So let's call 6 candles. Usually this market goes up for 6 candles on an hourly chart, and we're currently on candle number 5 to the upside, meaning we still have a little bit of time to get into a trade and continue to the upside. Now, to be clear, just because something usually goes in a direction for a certain amount of time doesn't mean it always does. It's not guaranteed that you're going to get 6 candles out of it and then that's it, it's going to change direction. That depends on many other things. But just as an average, as to where statistics tell us is most likely, we know that we've got at least another candle or two to continue this move to the upside. Now, for some people, you might have rules that say you would take that to double that. So, for example, you might say here, and for those that understand UFOs, this might make a bit of sense. You might say here, well, yeah, okay, we might be coming towards the end of a usual move, but there's nothing in the way till here. There's no sell orders that could change this move to the upside on this same time frame for quite a little while. So I'd be happy to ride this out until that number is, I don't know, 7, 8, 9, maybe 10, up to double what it normally is. You might have a rule that says, no, once it goes past what it normally does, I don't do it at all. And again, that's up to you to be strict or not in terms of how risk averse you are, how risk tolerant you are. But hopefully that makes sense in terms of perhaps looking at this and saying, okay, I do have room for it to continue to the upside, and there's nothing that's going to stop it in terms of sell orders until quite a way above us, which again gives us more probability of a continuous move upwards. So that's question number 1 answered. What should we be doing? Long, short, or do nothing? In this example, we are going to go long. But do we just go long anywhere? This is where we need to be stricter on what we're doing. We can't just buy because it's a good idea to buy. If you do that, you're buying in the middle of nowhere, which means it's harder to reduce your risk, it's harder to maximize your profit, and it's harder to get probabilities on the side. So if we're going to go long, question 2 always is, if long, where? If short, where? Where am I going to buy? Where am I going to sell? I already know that one or the other is a good idea, but the next question would be, okay, where do I do that? When we say where, we mean where in price. That's what we use UFOs for. So UFO stands for, let's write this out, unfilled orders. By the way, guys, I'm seeing some names on there that I recognize. I'm also seeing some names that I don't recognize. So some of you might have obviously joined us before in our sessions, and means you already know all of this stuff. Some of you might be completely new and you've never seen it before. Let me know where you're at on that so that I know whether or not I need to explain things in more depth or maybe go through things quicker. So just give me feedback as we go in terms of your experience, whether or not you've seen this before, whether you know what unfilled orders are, whether you know how to use the technology, or whether or not it's completely new. That would be really helpful for me. So just give me a heads up on the chat box on that one there, guys. Okay. So when we're looking, I'm going to continue explaining, but again, I'll keep my eye on the chat box. So when we're looking at unfilled orders, what this means is essentially we expect there to be stacks of buy orders in a market waiting below price that are waiting to be filled. Now, usually these are going to be institutional. Usually these are going to be the big boys. The reason we say that is because the app that we use, Auto UFOs, so Auto Unfilled Orders, is looking through price data and loads of other data as well, volume and all kinds of things, to show us where we have high probabilities of big stacks of buy orders. There's only really going to be big stacks of buy orders or sell orders within a certain range by professionals, because they know where they're buying before they do it. They've probably already bought at that price before and they have some left over. And so what the app is doing is it's going through and it's showing us, here are your buy orders in the green, the little green UFOs, and you'll see there's green lines or sort of dash lines on the top and bottom there showing the bands. You'll also see on the right-hand side, we can see the numbers that these bands relate to. So we've got all of that. And here are our sell orders, the little red UFOs. Again, with the little red lines with red highlighted on the price chart or the price axis there, showing us where that is being, where those prices are, or where those sell orders are between those prices as well. Okay, so we use our unfilled orders to say, okay, if we're going to buy, surely we want to buy amongst other buy orders. Now, why do we want to do that? Well, like anything in life, if you have loads and loads of buyers of something, usually that pushes the price up. Not always, but usually. If you have loads and loads of sellers of something, usually that pushes the price down. Not always, but usually. It's that balance between buyers and sellers. So if we're going to buy, we want to buy where there are big stacks of unfilled buy orders, meaning buy orders that are also waiting to come into the markets, and we buy when they get triggered too. So that's what we're using that for. However, there is now one extra element. Let me just put these back on the chart there. So there is one extra element to this, because you might be thinking, well, hold on, there are different UFOs here. So we have this top one, we have one beneath it, and we have one beneath that. How do we know which one to take? How do we know which one has the greatest probability? You have to bear with me, my mouse has been there today. To use the one on the top again. So with the UFOs, how do we know which one to pick? Now, some people might just say, I'm just going to go for the top one because it's the closest one to me. And that's fine, you can do that. But again, what we do here at Tradewith, it's all about probabilities lining up in our favour. So far, we already have probability to the upside. Our autopilot is telling us that. We have probability that there are buy orders here likely to push price up, and here, and here. So we need to add an extra layer of probability to have this line up as best as it can to make the use of our money and use of our time as efficient as it can be. So what's this third layer? This is where we come back over to our bigger time frame here, and we're looking at our EMA value. So we have here EMA. We have our EMA value here. So EMA stands for exponential moving average. So moving averages, we're seeing them a lot on charts and on the news at the moment with COVID. It's simply a line that follows price data or any data to show you an average over the last X amount of data points. In this case, we're using the 9-point moving average, which means it's taking the average of the last 9 candles and it's showing us what that average is as a line. Now, clue is in the name there, moving average, meaning it moves. So you might have noticed from when I froze the screen to when I moved it again, it's changing. This number is changing. Because it's moving, it's following price. As price data changes, the average obviously changes because it's taken into account that new information. So why is this important? Why do we even care? Now, the reason is because when we are trading in any platform across the world, most people have access to EMAs, meaning a lot of people are using EMA values to help them place trades, to buy. If price is above the EMA and then comes back down as it's done right now, then usually what people do is they buy at that moving average. As we can see here, if price is below the moving average and then comes back up, then people sell at that moving average line. Again, not always. We can see price has gone through it in different scenarios. But again, a general and a very common way of looking at the markets is to do that, to buy and sell at that moving average price. Not just retail traders, but hedge fund managers as well will do things like that. So again, why do we care? Because if at a moving average line, in this case, buyers come in, and we have a UFO where buyers come in, and we have probabilities to the upside on our autopilot, then we have loads of different probabilities stacking up on our side, which is great. Again, it means the use of our money and time is much more efficient than simply buying or selling at random, whatever the price is now. Now, we need to be strict with this. If you're going to use the moving average as part of your, the EMA, the exponential moving average, as part of your trading methodology, then again, you need to be strict about how you use it. So, this is saying to us right now that the EMA value right now is 1.2789, which is here. That is just above this UFO. Now we want them to combine, we want them to go together. So ideally what we want is an EMA value kind of in the middle. It can be just inside, just inside the top or just inside the bottom, that's fine, but it needs to be inside that UFO. For this opportunity, we do not have that EMA value lining up inside the UFO, which means those two forces are not combining. They're close to each other, but they're not combining, so not worth our time and money. Again, you could be somebody that just uses the moving average for your entries. You could just use UFOs for your entries. But for us, we combine the two to increase probabilities. So in this particular example, it was close, but didn't quite work out in the way that we wanted to. We didn't have those two forces lining up with each other. So just looking there, guys, you guys are particularly quiet today on the chat. Let me know if you have questions. Let me know if you have, let me just see if I'm looking at it wrong. There you go. Let me know if this makes sense. Let me know if you've traded in the way that we trade before, if you use this methodology, if you use this technology, if you're completely new. Just give me an idea of where you're at so that I can either recover stuff or I can get through things a bit more quickly. So let me know where you're at. So in the meantime, let's come back to our list of opportunities that we see here on the scanner. Now, as we can see, this top opportunity, we had the dollar Canadian. It's now no longer a yellow box because it's not showing us that we have a decent opportunity here. We have a new one at the top there, which is the dollar yen. Now, what I'm going to do is I'm going to go to a bigger time frame, if we can, if we've got a decent opportunity there. I'm going to go to the New Zealand US dollar, just because it gives us a little bit more time to play this out. So New Zealand dollar, we're using a daily chart for the bigger time frame. That will mean that we will be using a 55-minute chart for our smaller time frame. So we'll show you that in a second. I know that's a weird number as well. I'll explain that in a second. Now, why am I picking this one rather than the one above it? Because at the start, I think some of you might have missed this, but at the start we said we're going to avoid the pound today. There's a lot of high impact news coming out on it tomorrow. So we don't want to be caught in a trade where the news goes against us and we end up getting slippage or something like that. Just seen there from Rocky Pinto, newbie here. Okay, cool. Rocky, since you're the only person that has responded to that, I will assume that everybody is a newbie, and I will follow through in that way. So hopefully it's making sense so far. Let me know if I've confused you at any point. Okay, so if we're looking at the New Zealand versus the US dollar, we see here we have a near sensible long, and we have a nice thick blue box there, which tells us probability to the upside and an opportunity is close to us. So let's go and have a look at that. So New Zealand versus the US dollar. Again, I'm just picking the data here on the top as it comes up at the top, which is FXCM. Again, you guys could pick from different brokers if you use different brokers. Now, we want a daily chart on the left and a 55-minute chart on the right. Now, why do we have 55 minutes? That seems like a bit of a random number. The reason for that is because we want to, again, combine forces. So we want to know if we have common, like what we were talking about with the EMA, if we have a commonly used strategy where lots of people are going to be buying or selling, that's a good thing that goes in our favor, because if lots of people are buying and we're buying, then we have more likelihood that that continues upwards. So we want to combine common and what other people do to help us with that. But we also want to combine having a bit of an edge, because I don't know if you guys know this, majority of people who try and trade, normal people like individuals who try and trade, lose money. It's a hard game to play. So we don't want to necessarily do things exactly as how the majority do it, because the majority don't do very well. So we want to have a slight edge here. So we use our UFOs for our entry on slightly off time frames, so 55-minute chart, as opposed to a 60-minute. And that's because every retail trader in the world has access to a 60-minute chart. In order to get access to 55-minute charts, often you need to at least pay a few dollars a month. It's not a lot, but you have to at least pay something to be able to get access to them. Not always, but that's normally the case. So it says that people looking at these charts are slightly more serious about what they're doing, which might mean that they're slightly more skilled. But also, the number itself, why 55, why not 57 or 56 or 51? The reason for that is because it's a Fibonacci number. Fibonacci numbers are used in computing systems, used in loads of things, especially used by big banks and institutions, big hedge fund managers. They'll be using Fibonacci's as they trade. Again, not 100%, not definite, but again, we're just trying to add more probabilities on our side to say if we're looking at Fibonacci numbers for the time frames, they're likely to be the time frames that are used by the big boys, which means our entries can be much more probable. So that's why we do that. We're combining what everybody does with also what the professionals are doing to, again, give us the highest amount of probability. So hopefully that makes sense. Okay, so very quickly here, we can see that we won't have an opportunity, and I'll explain why. So yes, we have thick blue dot, confirmed upwards climate, probability to the upside, happy days. We have a UFO here, but you'll see this UFO starts at 0.7161. The EMA value is currently 0.7182, which is here-ish. So again, we don't have our EMA and UFOs lining up. So That means not a trade that we want to be taking. We don't have probability on our side. Now again, you do have some probabilities with just the UFOs. You do have some probabilities with just the moving average. So if you're happy to take those as they are, that's fine. That's up to you and your trade plan. But again, for us, we want to combine those things. So again, no worries. We'll just move on. And again, this is the good thing about using the scanners is we don't have to go and look through sets of charts all the time to find our opportunities. So nothing more on these daily climates here for the majors, because as we said, we're going to avoid the pound because of news coming out. We just looked at the New Zealand dollar and it didn't quite work out in our favour, and everything else is hopeful and therefore not what we want to be doing. So let's come across to our daily climates here, our minors or our cross pairs. Let's look here, we have the Euro Swiss. I'm pointing this one out because it's the first one that's a yellow box that says near sensible something. In this case, it's near sensible long. It also has the box there coloured in. So let's have a look at the Euro Swiss. Just reading there. Hi, Becky. I'm from Vancouver, Canada. It's 7 a.m. here. Need to leave home for work now. Thanks for listening. I'm brand new to the trading world. I will keep learning things. No problem, Mandy. We do these sessions regularly, not just me, my colleagues as well. So hopefully the more you attend, the more you understand. Auto Climate, by the way, is an app, is free, so you can also download that and have a play with it. Just in there from T. Hank, question on the UFOs. Aren't the UFOs just where support and resistance areas are? Good question. The short answer to that is no. And the reason for that is because support and resistance areas are essentially they'll cut through price. So if I maybe switch that a little bit. So yes, you could look at this and you could say, yeah, this looks like a support, this looks like a resistance. And yeah, they might line up as well. So let's say, for example, if you are a support and resistance trader and that lines up with the UFO, yeah, great. But again, you've got more probabilities, you've got more odds enhancers in a sense. But this UFO here is showing us where sell orders are. Sell orders could be there for many different reasons. So yes, sometimes it might line up, but you might look at it and go, well, that doesn't line up. It becomes subjective. The more we squish this, the more you see. So for example, this area here that's being pointed out by this top UFO, that's not a traditional resistance line. Or if you look down here, you look down here, so we've got an example there. So this one, again, not lining up with what you would traditionally call a support area. So just change that. Oops, let me go back. So yes, sometimes they line up, and good question, because it's a kind of similar approach, I guess, but not always. So essentially what these UFOs are doing, they're running through different data points in order to show you where buy and sell orders are. Buy and sell orders can be there for different reasons. So for example, if hedge funds are using support and resistance and they've got big stacks of orders that are waiting there because it's support or resistance, then great. But it doesn't have to be support or resistance for them to have their orders there. So hopefully that makes sense as a concept. You said, okay, thanks. I think that makes sense. The order volumes are just from one exchange broker or many. Okay. Oh, yeah. Okay. So you mean the amount of orders that they have within the UFOs, if that's what you mean? I think that's what you mean. Good question. It is looking through, in this case, we're using data coming from FXEM to show us this. Now, obviously, in the world of Forex, there's no centralized exchange. So it's not all coming from one place. And that's true of any Forex broker that you use. You'll get the information from that brokerage. Now, if you were trading futures or stocks, then it's coming through from a centralized exchange, which means, again, the data, the price data that we see is reflective of many different brokers. In the case of Forex, like I said, no centralized exchange. So this will be looking at broker by broker. But to be honest, if we change this from FXCM to Oanda, so let's just make a note of this here. 7209 to 7220. Okay, so 7209 to 7220. If I change this to Oanda, we've got 7209 to 7220. So prices, the good thing about especially majors is that the differences in prices from brokers is not too great. So the price structure is the same, the data is going to be relatively similar, and so the UFOs that we see from one broker to another are likely to be the same. However, it might be Because sometimes you might look at TradeStation, for example. You might look at TradeStation and use a chart here. I won't open up the chart because it'll take a while to load, but you might use a chart on TradeStation and then come across to TradingView. You don't see that UFO anymore, and you see it on TradeStation, but you don't see it on TradingView. And that's because the data that TradeStation is using is coming from a different broker than the one that you're using on TradingView. So you can look, I think it's best to just use the one that's coming from the broker that you're using, because that's who you're going to be trading with, that's who you're going to be trading against. So I think that makes sense. So again, I'm using FXCM as a general thing just because it's at the top of our list, but you can use any broker. So hopefully that makes sense. Okay, cool. So yeah, this opportunity, no opportunity because we don't have the lines, the EMA line and the UFOs line up. So we're going to look at the Euro Swiss. Again, I'll pick FXCM from the top list there. So Euro Swiss was daily. Okay, so we've still got that. Euro Swiss. Okay. Okay, so again, just coming back to that support and resistance question. So again, you've got some in here that are not traditional areas. Again, maybe the more extremes might be, or you might see the breakouts where you might now have support where resistance wasn't and vice versa, but not always. So just to show that. Okay, so let's have a look here. It looks like we just about have an opportunity, which is great. Okay, so we have thick blue dot, confirmed upwards climate, probability to the upside, happy days, we're going to go long. We have a UFO, we have many UFOs. So we've got 4 that we can see there on the screen. If I was to zoom out, we'd see even more. So how do we know which one to take? Well, we use our EMA value, which currently is 1.0795. 1.0795 is just within this UFO, literally just, which means we have everything lined up. So now we're going to look to take this trade. Now, what I do at this point, and again, this is not necessarily part of the methodology, this is just a visual thing, is I like to just draw horizontal lines across this UFO, and then I can just double click on them and change the data on it. Now, I do that just because I don't want to lose where I got in and where I got out. The UFOs are showing us unfilled orders, meaning if the orders fill, it disappears from the chart. It's no longer going to show us that there's stacks of buy orders there if there aren't anymore because they've been filled. So I draw the lines on the chart so that if over time the UFO disappears, I can see what I've done. So the top number that we see there on the right-hand side, this one here, for our UFO is 1.0796. I'm just going to add a couple of tips just to compensate for the spread there. So 1.0798, that's going to be my entry. Now, stop loss, we have 1.0783. I'm going to take 5 pips off that. Let's just give me a little bit of wiggle room. So that's going to be 1.0778. Now, you see what's happened here is this line has now come into a new UFO. Now, that's a problem because what we don't want to do is, let's say we're in this trade, price comes in, it might move through the top UFO, but then it's hit another stack of buy. It might react to that one. So if we have a stop loss in the middle of it, it might be that we get stopped out just, and then price turns in our direction because there's still buy orders there. So we want to make sure that this stop loss area is not within a new UFO. Now, in this particular example, what we're going to end up with is our stop loss probably all the way down here, because by the time we've done this a few times, we're going to realize that we've come within this UFO and then we've come within this UFO. So we're going to want our stop loss right the way to the bottom here, which is going to be reasonable size. Not the worst, but not the best. But let's follow this through. So if we take this bottom UFO then, let's just move this down and then I can just double click so I can be specific on price. This bottom UFO, the number there is 1.0752. So let's make this 1.0747. So we've got five pips wiggle room. That's now our area, which looks pretty huge. I don't know about you guys, it looks pretty big. It's actually in reality, what, 50, 52 pips? So it's not huge. Now, it's still fine. We still have room, I believe. Let's have a look here. Still have room to the upside by quite a bit, so we're fine. Still happy to take that area, and it actually encompasses a bigger UFO as well, so that's fine. Okay, so I've drawn that on the chart. So now what I'm going to do is come across to my order panel, click buy, and then I just type in that information. So 1.0798 to 1.0747. By the way, I hope that makes sense on what I did with the stop loss there and why I did that. Essentially, we don't want to be selling out of a position if we've still got things in our favor to that upside, or downside if we're doing it the other way around. So that's why we've just encompassed all of those UFOs there, so that our stop loss does not fall within a stack of buy orders. We want it outside of a stack of buy orders, so that if it hits that bottom line, we really are wrong. We really didn't get that right. We want to get out at that, rather than see it turn just after we get out. Okay, so we can see here that it's a 51 pip. I did my math wrong there. I said 52. So 51 pip difference there between entry and stop. Now, the first target that we take is going to be really easy. First target that we take is 1-to-1 away. So if it's 51 pips between entry and stop, then we want 51 pips between entry and target. Again, why do we want to do that? We do that, we call it our safety target, and it's safety target for a reason. I'm just going to draw it on the chart here. I use a horizontal ray. Again, you guys can draw on your chart however you normally do that. I'm just going to type in the number. So again, trading viewers help me out here and giving me what that price value would be. So 1.0849. Now, we get out here, and the reason we get out here is because our final target is going to be probably quite far away. In fact, our final target is going to be this number right here, 1.0923. Let's just draw that on the chart. 1.0923. Now, what we don't want to do is price comes in, hits our entry, goes off, doesn't quite hit our target, and then comes back against us and stops us out. So we're trying to take price, or we're trying to take a target slightly closer to where we're getting in so that we are at safety quicker. So what we do is we split in half what our risk is. So half our risk goes on this first one, half our risk goes on the second. So that way, price comes in, goes off, hits 1-to-1, and then comes back. The worst that happens is we break even, because we took half our position off at 1 and then lost half of our position at -1. So it balances itself out. If it goes in our favor the whole way, then we take half of our position at 1 and then half of our position at 2 point something. That's probably going to be. Let's just call it 2. And so the overall profit is somewhere in between those two numbers. So hopefully that makes sense. Again, you don't have to use safety targets. You don't have to use final targets. You can just go all in, all out, at mechanical, 2-to-1s, 3-to-1s, 10-to-1s, whatever you want to do. Again, we're trying to do things in such a way where we have less probability of losing and higher probability of maintaining our capital at least. So that's why we have our safety target and then a final target, so that we can capture as much from the markets as we can without risking it not quite getting there and then losing it in the end. So what we're going to do is we're going to assume that the total risk of the trade is $100, meaning $50 for the first target, $50 for the second. So we're going to put $50 in there. Again, that's just a random number, just because it's half of 100 and 100 is an easy number to do this with. Of course, you guys are going to have different numbers. You might be risking $5, $500, $10, whatever you want. It's going to be relative to your risk tolerance and your trading account. We would say it should be no more than 2% of your total trading account, so that if you're wrong a few times in a row, it doesn't hurt you too badly. Ideally, 1% or lower, especially. Okay, so now what I'm going to do is just double check those numbers. 1.0798, great. 1.0747, great. And the target at 1-to-1 away, 51.51. So I press button. So great, that's now gone in. If I was connected to a broker, I'm connected to paper trading at the moment just to make the point, but if I was connected to a broker, say FXCM or Oanda or one of the others, as soon as I did that, that order would route through TradingView to my broker, and then it would be placed on that broker's platform, which I think is pretty cool. Let's just get our UFOs back on the chart. Okay, so that's one order that's now just gone in. Now we're going to put in the second. So we just do the same thing again, type in the numbers. So 1.0798, stop loss, 1.0747, and we're going to take profit at 1.0923. Now, I'm just going to stop here and explain quickly what the final target is for. So we've come across to our bigger time frame here to see where our closest opposing UFO is. And what I mean by that, opposing UFO or rival UFO, is that if I'm going long, meaning I'm buying, then the opposite of that is sell orders. If I was going short, meaning I was selling, then the opposite of that is buy orders. So we want to take our targets just before we hit a stack of the opposite of what we're doing. Because if I'm buying, that means I want price to go up. But if prices hit a big stack of sell orders, there's less probability that it's going to go up. In fact, it's more likely that it's going to come up, hit somewhere in here, and then fall. If it's falling, that's not good for me if I bought here. I want it to keep going up, which means I want to get out before the likelihood is that it's going to turn against me. So I look at my bigger time frame where we have bigger stacks of orders. That's generally true, by the way. The bigger the time frame, the bigger the stacks of orders, the bigger piles of unfilled orders there are. So I want to get out just before it hits that. So I take that number and round it down. So that number there is 1.09235, so rounded it down to 1.0923. So I get out just before we hit the big stacks of sell orders. So hopefully that makes sense as to where we got our final target from. You'll see here as well what's cool about TradingView is it shows you what the ratio is. So it's 2.45 to 1, which means we have 2.45 to 1 from our final target and 1 to 1 for our safety target. So the overall profit, if we were to hit both targets, would be somewhere in between those numbers. So I guess 1.22.5 or something like that. My maths isn't great, but it would be roughly between there. Again, you could figure that. So again, double check the numbers, everything looks fine, and then just click buy. So I've put $50 of risk, entry here, safety target here, stop loss here. And then I've put another $50 of risk, which is the color here, same entry, same stop loss, but we're taking profit at a different place. And we do that again whether you trade Forex, whether you trade futures, whether you trade stocks. We're going to split our position in half so that we can get out sooner and just at least lock in some profit so that the worst that happens is that if we get stopped out or if it hits our safety target and we get stopped out, we break even. We have less likelihood, hopefully this makes sense, that it's more likely the price goes a little bit in our favor than it going a lot in our favor. I think that makes sense. Like with everything, you're more likely to get small moves than you are to get big ones. So if it hits that and then stops us out, no problem, we break even. If it hits that and then hits our target, great, we've won 1.22 or whatever it is. We've averaged between those two numbers. If it goes against us, no problem, we've risked and we've lost what we were happy to lose in the first place. So hopefully that all makes sense. That's the process start to finish. So we're combining autoclimate, which is what we have here on the left, which is telling us whether to go long or short based on probability, statistics, data, objective. You know, that's not us looking at patterns to try and decipher anything. It's literally telling us thick blue dot, go long, thick red dot, go short, thin dot, lead a color, do nothing. It answers the question without any confusion. We then add in probabilities of UFOs where we see that we have big stacks of buy orders in this case because we were going long. If we were going short, we'd be looking for sell orders that are showing us where we have probability that there are big stacks of buy orders waiting to be filled, meaning probability that price moves up from there. In fact, we can see it already triggered, obviously before we put this trade on, it already triggered, and we've already seen move to the upside there, which is showing us exactly what we would expect it to do. So we have our UFOs, but we also add in our EMA value as well on our bigger time frame to add even more probabilities to this area working out for us. We're conservative with our safety target. We are more aggressive with our final target. So again, the balance between the two. Everything is about being as objective as possible, as balanced as possible, so that we are more efficient with our time rather than placing trades for the sake of placing them and then they lose. It's, you know, waste of money and waste of time. Whereas if we can put as many probabilities on our side, yes, it means we have less opportunities, but it also means that those opportunities are usually more efficient, much more likely to work out for us, or at least much less likely for us to lose. So just to say, for those of you that are completely new, like I said before, very briefly, Autoclimate is a free app. So you can use that. If you don't want to use the UFOs, that's fine. You can use Autoclimate, and let's say you're somebody that uses support and resistance, or you use Fibonacci, or you use something else. No problem. You can combine those things. Again, auto climate being free. All you need to do is go to tradewithufos.com/Becky, and then at the top there, just get a free membership and follow it through, and you'll be able to get auto climate from there. Should be relatively easy to find. The UFOs, depending on which platform you use, depending on which platform you use, have different costs. So on TradingView, they're $34 a month. On TradeStation, they're $89 a month. Slightly different functionality between them, but they're still doing roughly the same thing. And again, like I said, you can use just the UFOs themselves. You can use them with the EMA. You could just use the EMA. The most important thing that I hope people get when they attend my sessions is that they understand that consistency is the most important. If you pick a way of doing something, stick with it. If you change it all the time, it's really hard to see what's working well, what's not. It makes it hard to build confidence in a strategy because you hear somebody say a different thing and so you implement that, and then maybe that works one time and then it doesn't for 2 more times, and then you decide to change it again and you watch a different person on YouTube or whatever, and they give you something else to think about it. And it just confuses you. You end up doing loads of different things. The consistency isn't there, and then it doesn't work. If we want consistent results, we need to be consistent in our action. Just seeing there from Rocky, so in terms of trading discipline, should it just be 1 to 2% at any time or a particular trade? What's the maximum percentage we should be in at any time? Good question. So the numbers we give, the 1 to 2%, it could even be 0.5%, by the way. So anything up to 2%, ideally 1 or lower if you're new. That's a per trade number. Now, in terms of how many trades you should have on at one time and therefore how much total risk you should be in at any one time, that's more of a subjective thing to the individual. Because there may be people that are, let's say you are risking 2% per trade, then you might say, I'm not going to be in any more than 3 trades at the same time. So the worst that happens is I lose 6% that day if I'm wrong on all of them. If you were to say, oh, I'll have 10, 20 trades on at the same time, times 2%, then you could be risking 20 to 40% of your account just in one day or in 1 week. So again, subjectively, people are going to have different opinions on what's good or bad about that. Of course, risk and reward are linked. The more you risk, the more you get back if you're right. But the less you risk, if you're wrong, the less you lose. So you've got to balance that as a subjective thing. I would say if you're risking 1% per trade, I personally have a 5-trade cap, but that's a very personal thing. So just because I do that doesn't mean that's right. That's just the way I view the markets and the way I manage my own risk. But what I would do is just visualize, how do I feel if, let's say it's 1%, whatever number that is for you, how do I feel if I lose 1 trade? I'm okay. How do I feel if I lose 2? It's okay, but I'd rather not. How do I feel if I lose 3? And just do that exercise until a point where you feel physically something, and that will tell you where your number needs to be. So it should be less than that. So hopefully that makes sense. Okay, so I'm actually taking a little bit longer than we would usually. It's normally 45 minutes. So sorry for going over there, guys, but hopefully it makes sense, the things that we've covered. For those of you that come back and watch recordings, just because this trade might not be relevant to the live market that you're looking at right now, whatever time that is that you're coming back and watching the recording, hopefully the process of what we're doing, the scanners, auto climate, the UFOs, the EMA, hopefully that methodology makes sense. Hopefully the technology makes sense. Any questions, if you go to tradewithufos.com/Becky, sign up for a free membership, and then you can ask questions in a public forum so that other people can see the answers. Or you can email me, becky@tradewithufos.com. So that's it for today then, guys. I will see you, I think, in a couple of weeks' time. If not, my colleagues do these sessions as well. We do them on YouTube, so we'll see you somewhere. Good luck, happy trading, and take care, guys. Bye-bye.